Wanted to talk about some of my options that I'm trading. This is in a series, Options Trading for Beginners. I've got an entire playlist I'm putting together where I walk through my options trades and show what I'm doing and why I'm doing it. Now, first and foremost, I'm an economist, and I usually get involved in the markets in a certain way, looking for some kind of catalyst event. Right now, we're seeing the lack of catalyst events. That triggers me to get involved in a certain type of trade. That is a credit spread. I mentioned this just on Friday's video, the video I did from Friday's trades, that I put a credit spread on. It's a 2-day trade. Today is Tuesday. That one has expired. I like a little bit of juice in this, in the sense that I want a lot of comfort. I'm going to break down the credit spread that I did. I also did on Monday a straddle option strategy, something I do on a regular basis. For both of these are for SPY stock, and I'm going to break both of these down and keep them in my series, Options Trading for Beginners. Let's jump in. I'll break down how these two trades went down and how much I made. Not a whole lot, but I did pretty well, and if I continue to do that, it pays the rent. Let's jump in. All right, as I mentioned, this is Options Trading for Beginners. We're looking at SPY stock over the past 3 days. The white section is day trading, then you get after hours, the bluish, then the yellowish is pre-market. Wednesday, we had a big run. Typically, I like to step in after the fact, fading the market. And as you can see, Thursday's price action, not exactly a whole lot there. As it turned out, Thursday was basically flatline. Friday, kind of the same thing. So on Friday, I stepped in, and I probably should have done this trade on Thursday, but I had a bunch of other things going on, and so I didn't really get too active on that. But going into the weekend, I bought a 2-day expiring Tuesday. It's a option strategy called a credit spread. And basically what I'm looking at is, I'm basically saying, looking at this, saying we're probably not going to go much higher. That I'm going to sell this, take in a credit on the credit spread option strategy, and from there, taking the profits. It's not a lot. I think I took in just a few points. So the reference at the time was 529.20, and I was looking at a 537 call to sell and a 538 call to buy. Now, your risk at this point, because you're selling short a 537 call, your risk is any price movement above 537 for SPY stock, but I bought a piece of protection, the 538, and I paid 16 for that. My total that I took in, the credit for the credit spread option strategy, was 12 points. It's not going to really, if you're doing one lots, if you're capable of doing one lots in your brokerage firm, you're not going to necessarily pay the bills on this. But once you start getting into 10, 20, 25 trades at a time, depending on how your margin goes for your specific brokerage firm, that $1, if you're doing, say, 10 lots, you're only risking 1,000, but you're bringing in potentially 120. And if you're doing one lot, you're looking at $12. That's not even going to buy lunch at today's prices. Regardless, and I don't really come in here and talk about the size and all this stuff. You get a lot of guys who sit there, go rent an Airbnb and tell you how wonderful their trading programs are, and from there, click away. That's not me. We'll reference one and that 12 right there. But going forward, mathematically, this is where I really boil everything down. And I ask such a simple chance, what is the statistical probability that I'm wrong? Number one, this is a 2-day option. Putting it on end of day Friday, towards the end of the day on Friday, expiring end of day Tuesday. I do not want the market to go above the reference point 529.20, but should it go above 537, I start to lose money. The most I'm going to lose is 88 points off this. The most I'm going to earn is that 12 cents. But when we look at the open to close over the past 100 trading days, this gives us an idea of what the probability is that this is going to happen. The open to close range is about 0.4%. So that's about $2. So statistically speaking, when you have a reference of say 530, you're looking at about 225 on average that the market might move higher from the open or the close, higher up or down. Given that, 2 consecutive days, I'm looking at 450. This is well below the 537 on average. The problem with that is anybody can say anything at any time. People can wake up Monday morning and say, let's just start buying everything. And that's the risk. But the risk is contained because I also bought those 538 calls after selling the 537 calls. So here's how it actually played out. And if you look backwards, you can see Wednesday was the launch. You see Wednesday's price movement, then Thursday, Friday, Monday, Tuesday. Really, the market didn't go anywhere. So I kept my 12 points. That's what I intended to do. That's what I was looking to do with that particular trade. Once you start hitting into 10 lots, now you're looking at $120 a day. Multiply that by 5. If you're able to scale up to that size, you're looking at a couple $100 a week. It starts to add up. $600 a week. Start doing that. Use that as your to scale up and build up more position size. Keep in mind you're only risking that $1, but you're only profiting about 12 cents. So you can be wrong 1 time out of 10 and take a hit. But because of the probabilities, I feel like this was an easy trade to put on. We have a big event on Wednesday, and this is usually what I'm looking for, is a catalyst event. I'll try and put this trade on to expire the day before that catalyst event. Because once those catalyst events occur, things go crazy. And you don't know what's going to happen. More than likely, Wednesday morning, I'm going to step in and buy a straddle option strategy where right at the open, within the first 5 minutes, I buy a put and call both at the money with the expectation is that the market's going to move, but I have no idea what direction it's going to move. Because of that, I'm probably going to have a pretty high probability event that I will be profitable. It may not be much. I'm usually looking for anywhere from 25 to 50 cents, sometimes as high as 75 cents. Usually what I end up doing in that case is just letting it ride. Nonetheless, I break down some of these trades. I'm going to continue to do this and put them in this series that I have, Options Trading for Beginners. There's an entire playlist that I'm going to start building on. Of course, I just launched this particular channel back in October. And this is something I'm doing new, Options Trading for Beginners. If you're looking to better understand option strategies, make sure to hit that like and follow button. If you're looking for written content on value investing and things like that, I've got my Substack. We'll see you in the next video.